we'll just start off briefly. A lot of people have heard about the Fed. They've heard about the Chicago Fed, but they may not know outside of a quarterly meeting what the Fed really does. So just give us a 30,000-foot overview about what the Fed does and what you do in your role.
That's what do you do all day? Look, thank you for having me. It's great to be back in Springfield. I'm disappointed. I thought I was going to get another horseshoe sandwich, but we didn't get a horseshoe sandwich. What is the Fed? Why does Chicago have a Fed? And if you see the polling, some 70, 80% of people say they don't know what the Fed does, but they don't like it. They think they're doing it badly. The Federal Reserve Act set up a kind of a quasi-public, quasi-private system where there's a political appointee Fed system of governors in Washington, D.C., and there are 12 reserve banks spread around the country because in 1913, just like today, people did not want Washington, D.C. and Wall Street to control the entire U.S. financial system with no input from the rest of the country. So they wanted independent voices from the regions. And look, we can argue about in 1913 when they set it up, there was hardly anything in the West. So San Francisco Fed covers the entire West Coast. There's 2 of them in Missouri. Fine. There are a bunch of details, but the basic idea that we ought to have when setting monetary policy and institutionalized independence that comes from around the country, I think is actually a stroke of genius and is one of the reasons why the Fed is credibly such a fabulous central bank. The things the Fed does, in addition to monetary policy, which you know about, we go every 6 weeks to meet at the Fed in the FOMC meeting. Shades come down, huge table. They go around the table. Jay Powell says, here's what I think about the economy. Go to Governor Chris Waller, what do you think about the economy? We go around the table, and I, with no irony, I consider the FOMC the world's greatest deliberative body in the 21st century. We're coming from different places and different perspectives, and we take it very seriously when setting the interest rates. The other things the Fed does, much of the payment infrastructure of the United States, wire transfer, ACH, payments, direct deposit, FedNow, instant payments, those are running on Fed rails. $5 trillion a day are going in payments over those, and we got a lot of people work in that space. We are a bank to banks, so if you're a member bank of the Fed, we provide a bunch of financial services. We are also the distribution point of all the cash in the economy, so we have a vault with tens of billions of dollars of cash in there. And every day we run hundreds of millions in and out via armored carriers that go to fill the ATM machines. Bank supervision, we got a lot of employees who work supervising the banks on location or central. The policy's determined in Washington, but the actual on-the-ground bank supervisors are employed by us. And then we, the reserve banks, are meant to be upstanding members of the community, and we engage. We have, some of you here are on we have a variety of advisory committees. We run almost 40 roundtables around the district where we talk to business leaders and civic leaders to try to get a handle on economic conditions, which are not coming with a lag. The official data, as you know, come out with a 1-month lag. Controversially, are revised, but that shouldn't be controversial. Our economic intelligence gathering is an important function. So those are the kind of the main functions of the Fed.
And we're going to get into it, kind of the elephant in the room. We talked about it, and you talked a little bit about the independence of the Fed. But, you know, obviously we've seen the president talk about firing the current Fed chair, politicizing. Talk about the importance of the Fed in your view.
universe is as big as this, and politics concerns all of this, and the Fed's role in society is this narrow. But in this part of the universe, what the Fed does makes a huge difference. And we're not the bad guys. We're the guardians of the galaxy in that part of the universe. And I try to stay out of, I'm out of the elections business. You become a sworn member of the Federal Reserve, you don't do that anymore. So I try to stay out of the political scrum. Before I was ever at the Fed, I was an economics professor at University of Chicago. Economists are basically unanimous on the importance of Fed independence, central bank independence, not just the US, everywhere. That the central bank be independent from political interference is vital, because if you look at places where they don't have it, you know what happens. Inflation comes back. The interests of the partisan politics are not, they're not always lined up to be the same with what's best for the economy. The Federal Reserve Act gives the Fed a dual mandate of the only things we're supposed to do when setting monetary policy are stabilize prices and maximize employment. And that's it. It doesn't say anything about make the stock market happy. Doesn't say anything about do what the president says. It's important that we have that because we don't want inflation to come back. And I think people can understand that.
I do like it when the stock market is happy, by the way.
Yeah, look, if the economy does well, everybody does well. And that's what should drive our decisions.
Getting into the economy, talk about economic trends. In your role, you oversee 5 states.
Yeah.
You obviously have a number of counterparts, right? So what are the economic trends driving the Midwest in your region? How does our region compare to other regions around the country? And you talk about stability. What can businesses or policymakers do to ensure that long-term stability and growth and competitiveness?
Ooh, we got 2 dissertations in those. So this district, the Chicago district, is 90% of the economies of Iowa, Wisconsin, Illinois, Michigan, Indiana. It's kind of heart of the Midwest is what the district is. That is the most manufacturing intensive of all the districts, by far the most auto production of all the districts, heavy in the agriculture economy, and because it's got that manufacturing focus, tends to be among the most cyclical of all the districts. So there is a sense in which in normal times, normal business cycle times, we're a little bit canary in the coal mine, and people will tend to look to Chicago Fed. What are you hearing from durable goods makers? What are the automakers saying? Because that tends to be a little bit of a leading indicator of the overall economy. The only reason I hesitated when you asked is this has been such a weird moment for the economy. The last 5 years are really unlike anything we've ever seen. They look nothing like a normal business cycle. So you had a recession in COVID where it wasn't durable goods going down. Demand for durable goods went up. People start buying more cars. People want to buy more housing. They want to buy more TVs. And the thing that drove the recession, as you know, was a bunch of stuff that's normally recession-proof. Services, and you can't go to the doctor, and people aren't going out to restaurants, and a bunch of things that are not very cyclical are what went down. And so now as we've come out of that, the boom, in a way, can be summarized by the Peloton problem. The demand for Pelotons went way up. And normally you'd think that'd be cyclical, so in a recession, demand for Pelotons will go down. Now we're coming out and it's a boom, but the demand for Pelotons goes down and other manufactured goods goes down as people start shifting back to spending money on services. And then the Fed is trying to figure out how interest rate sensitive is going to the dentist. And the answer is maybe not at all. You know, the normal reason why the Fed is the tip of the spear for stabilization is that those same cyclically sensitive industries are also the most interest rate sensitive industries. So it normally makes sense. It's like, the economy's overheating. Then we tighten the interest rate and it kind of cool it down. Things are looking like they're chilling. We lower the interest rate and kind of heat it up. We've had the representativeness of the business cycle for the 7th district's gone away a little bit. That said, starting around April 2nd, a lot of what we were hearing in this district, and you know it, is coming from the ag side and the manufacturing side was, whoa, if the tariffs are going to be as big as this, if there's going to be this kind of retaliation, we could have some really big problems. This could send us back to an environment where costs are rising out of control again. Last 3-4 months, that's settled down a bit. We've had some exemptions. We had the exempting of anything that's USMCA compliant. We've going to tone back. Maybe we sign some deals. There won't be retaliation. So we're still adjusting to maybe it won't be as bad as the hair on fire around April 2nd. But I think that to the last question of where, if you're just a business person who's here in Springfield or you're in the Midwest, how do you stay competitive? There's a more real-time information gathering component. Look, it's always been true that you had to keep track of geopolitics and economic trends as well as financial trends, but that's just gotten absolutely front of mind. That you have to keep current with that because it feels like stuff's changing every week now.
In drilling down, you brought up tariffs, and you've talked in commenting, you call it the drip, drip, drip of new tariff announcements and their potential to complicate things. You know, manufacturers, the business community, we're now in a global environment. 95% of the world's consumers are outside the United States. So at the Fed, how do you factor in tariff announcements or potential tariff announcements, or there's another 90-day delay and you're looking forward on what you might do in rates? You know, how does the Fed look at that when you look at economic modeling and in supply chains? So talk about how you are trying to balance these tariff announcements and, to your point, the drip, drip, drip.
All of the above. You mentioned a bunch of ways that you could monitor and or respond, and we do all of those. I should have stated at the outset, the rules say I'm not allowed to speak for the Fed or for anybody else. I can only speak for myself. And then usually my colleagues are like, oh, phew. Oh, God. But the thing about tariffs, before there was April 2nd, my basic view of the economy was, it's looking pretty good. The growth is solid. The unemployment rate and the various measures of the labor market are consistent with stable full employment to me. And if you looked at inflation, it got way too high, but it's been coming down, sometimes slowly, sometimes rapidly. But to me, that looked like we're on path to get back to the 2% level of inflation, which is what the Fed always says is our target. In a world like that, where you got stable full employment, inflation's coming back to 2%, growth is relatively solid, I thought rates should go from where they are now, which is a little bit high, to something like where you think they're going to settle. In the language of the economists, if you got pi close to pi star, pi is what our symbol for inflation, and you got u close to u star, then you should move r close to r star, and that's well below where we are today. And the problem was what I call the throwing dirt in the air. Like, can you be sure that you're still on that golden path if you start seeing prices go up and you start seeing employment go down, because tariffs, in my view, are a stagflationary shock. It makes both sides of the mandate go bad at the same time. And that's the worst position that a central bank can be in, because there's not an obvious answer of what you do. It's not like If the economy's overheating, you tighten. If the economy's overcooling, you loosen. What do you do if they're both going wrong? Now you got to decide, well, which one is going wrong more and how long is each side going to last? There's a theoretical case that if it's a one and done tariff that just increases the cost one time, you get inflation one time, but it's a transitory inflation, so maybe you could just ignore it. That makes me uneasy, not just because they used that word transitory before, and it wasn't that transitory, but also because that's only in the theory of a one and done. So if we're going to keep saying, now we're going to add 100% on semiconductors, and we're going to renegotiate the USMCA in 2026, now you got to think about, well, is this going to be a one and done? And if we're going to start applying the tariffs to intermediate goods, like parts and components and supplies, like semiconductors, that's more than just affecting the prices of the directly impacted goods. Now that's a tax on the other manufacturers. So we just need to keep sniffing. When I first got there, they asked me, "Are you a dove or are you a hawk?" And I said, I don't even know if I like birds. I don't aspire to be a bird. I'm just there to be one of the data dogs. And the first rule of the data dogs is sniff everything. You know, there's no when is the time for sniffing. And this is one where before September, as we go into the fall, these are going to be some live meetings. And we're going to have to figure it out. And the hardest thing that a central bank ever has to do is try to get the timing right when there are moments of transition. So I see, I'm not speaking for them, I see them on TV, my colleagues on the FOMC, grappling with the same thing I'm trying to figure out, which is are we still on the golden path? The economy's going fine, inflation's going to come back down, or are we getting into something where the costs are going to start rising again, and then we got to be a little uneasy?
Yeah. So looking at, you talked about data, and so we saw data come out here in June showing the CPI, I think, annualized is up like 2.7%. Core inflation was about 2.9%. And to your point about trying to get on that golden path back down to a 2% inflationary rate, obviously it's under intense pressure in the microscope from politicians and from business community. And as of today, at one point you had talked about the stickiness of inflation, and you kind of talked a little bit, but when you look at these guideposts for making determinations about whether we're going to reduce rates, increase rates, what are the 2 or 3 or 4 factors, and does one rank higher than other? Is it consumer cost? Is it labor market? How do those rank in priority?
They rank equal in the dual mandate. Prices and employment are the same. But if we're looking at prices, I find informative, a lot of times we'll look at headline inflation or core inflation. I like breaking down the categories and thinking a little bit about what the dynamics are. So it would give me more comfort if, and for a couple of months we had reports like this. The overall inflation was coming in low and below what was expected. Great. And if you broke out the components, the inflation that we saw was kind of restricted just to goods and heavily to the things that the tariffs apply to. So at least there, it's kind of staying in its lane, I would describe it. And it's worth remembering, imported goods is only 11% of GDP in the United States. We're overwhelmingly a domestic-driven economy. So if tariffs are not freaking everyone out and changing people's behavior, and they stay in their lane, there is a sense in which, yes, you'll see them, but they don't have to be a material knock us off the path kind of thing. If we start getting more reports like the latest one, the latest CPI though, where the overall is inching up, and if you look at the components, services inflation was bad. There's no other way to describe it. And services are not obviously tied to the tariffs, so everyone's hoping that's just a blip. You know, there's noise in the data. If you start to get multiple months where the components suggest that the impact of tariff inflation is not staying in its lane, then that would be more of a concern.
And I think at the last meeting, and someone in the audience had submitted a question through Mike, and they talked about the unusualness at the last meeting where Michelle Bowman and Christopher Waller voted to cut rates, and 9 didn't, and kind of the double dissent that you don't see a whole lot. So is that kind of precursor that you think they'll be cut next time? Obviously, you're going to look at the data, make the determination. But what do you anticipate if you're able to say?
He's trying to get me in trouble.
I'm
you
trying.
can see, I already told you, I can't tell you. That combines the, like, I'm going to speak for the Fed and for my colleagues.
Yeah.
But I don't, it does, look, it
I can
doesn't
try.
stress me. You are right that it is unusual. And that part's public. You don't usually get that. There was an older time in the Fed where there were more dissents, and at some other central banks where they have votes, there are more dissents. I have found it you can see where we each come from as a perspective can be very different. We're coming from very different perspectives. I've been super impressed with the maturity level of how we think these things through. And we have different views of the economy. As I say, for my decisions, how I'm going to vote for September or at the 3 later meetings of this year, I don't like pre-committing. I know some people are coming out and saying, no matter what happens, here's how I'm going to vote at the next meeting. I don't like doing that because I like to hear from my colleagues and their worldview, and B, I like to get all the data that we can get. We're still going to get some PPI readings on inflation and another CPI reading on inflation before the next meeting, and I've highlighted what I'm going to be attuned to looking for. And on the employment side, we might want to take 30 seconds and think through a little bit on that detail, which is we got these revisions. So the initial jobs numbers came out and they were pretty positive. Then with the revisions, they reduced it, a couple 100,000 for those previous months. And the latest month was around 75,000. In normal times, that monthly payroll jobs created number is kind of a tentpole number. That and the unemployment rate are the 2 best numbers that we have as an indicator of where are you in the business cycle. But what I want to caution everybody with over-indexing on monthly payroll jobs numbers in moments where there's uncertainty going on behind the scenes about population growth, okay? And especially from immigration. We saw in 2023 and in 2024, the monthly jobs numbers were way too big. We were getting 150,000, 180,000 a month of job creation, and our estimate of what's the break even, as we call it, for jobs, about 80,000. So there's one worldview as it was going along that said, oh, stuff's on fire, we're about to overheat, inflation is going to reignite because we're generating more jobs than is the break even. Now looking, but it didn't happen. Inflation didn't go up, inflation just kept coming down because the break even was wrong. There was a bunch of population growth coming predominantly from immigration, but also some other demographic changes that meant that as an indicator of the business cycle, you just should have been careful. You just wanted to be careful. I'm not saying you'll never hear me say throw the data away. It's just be careful. And now, if we're going into a period of transition on immigration, the same thing could happen on the other side. We could start having 20,000, 50,000, something a month lower than the perceived break even, but it wouldn't be a sign that the economy is going into a recession. It would just be a sign that the population growth rate is smaller than what you knew. And at moments like this, I have found it more helpful to look at things that are kind of a ratio, that in the economist language are more scale invariant. Okay, it's something like to add up all the jobs in the economy that depends very much on what's happening to population. The unemployment rate, the hiring rate, the layoff rate, the job openings rate, those are as a share of jobs. They're less susceptible to change population changing that. And if you look at those, so far they still are showing pretty steady. There are elements of concern. The hiring rate is kind of low, but the job openings rate is actually pretty high compared to historicals. It's about the same as it was in 2019, which was a very hot job market. And the layoffs, the rate of layoffs is actually below that. So we're in a kind of a low hiring, low firing economy. Those are the things that I'm going to be. That was the long version of those are the things I'm going to be watching.
In turning to the labor market, which has been, to your point, relatively strong, we do see in certain populations, certain sectors, a shortage of skilled workers. But you know, what a couple multi-pronged. How do you view the current state of the labor market? Are we at full employment? How do you see wage growth in terms of inflationary pressure, or is it necessary and sustainable? But two, and you started to go down this path, the role of immigration in the labor market and the importance, but especially what we've all heard recently is AI, right? And automation, you're going to lose all these middle market folks. How do you look at things like that in the labor market, making decisions going forward?
You made me take out my pen. I got to write them. He asked me questions. That was 3 questions. Each one of them is massive. Let's think about what's the state of the labor market. I think state of the labor market is pretty strong, pretty solid, has backed off from white hot, unbelievable, nobody can find a worker, they've never seen anything like this. Now it's moved to a kind of a traditional, sustainable, full employment type model, is my read. When I talk to business folks here in the 7th District, they kind of describe that. They say, hey, it's still hard to find people, but it's not impossible, and things seem fairly steady. The wage pressures, are there wage pressures on inflation? You can't answer that without knowing what's the productivity growth rate. And productivity growth rate has actually been one of the strongest things in the economy, relatively unsung by the press, but just the output per worker and output per hour had been lower than historical for about 10 years. We went weirdly crazy during COVID, as you might imagine. But as we came out of it, it's been 50% higher than the trend before. Let's say it went from 1.3 to almost 2%, which seems like, if it's 0.7%, what difference does that make? It makes a huge difference over the long run. And basically, whatever the productivity growth rate is determines how fast can wages grow without generating inflation. So I haven't seen wage price spiral, if you want to think of it that way. As I look at wage growth, it's still strong. It's faster than inflation, but it's fully consistent with 2% inflation, I think. Danger from tariffs is that they reduce the productivity growth rate in manufacturing, in anybody who's affected, in which case then you might have to start thinking a little bit about this secondary effects. If the costs go up, then the prices go up. If the prices go up, are the wages going to go up, and we get in a spiral? The AI question is a deeper, longer run thing. Most economists look at technological improvements. The question of will AI replace everyone's job is a different way of saying, is the productivity growth rate going to go up so much that we no longer even need people to work? There is one aspect of that where that will make us unbelievably rich. Wages will be able to go up a lot if we get productivity growth like that. And it is true that in previous technological waves, it hasn't driven the unemployment rate to 100% in the economy. Mostly what it's done is increase our incomes. So there will be transitions, but I'm fundamentally quite optimistic of the economy's capacity to incorporate new technologies and turn that into a way to create new jobs and create higher incomes.
And we have a great higher education system here in Springfield, University of Illinois, Springfield, Lincoln Land. One of the questions that came in talked about some of the changes at the federal level, funding reductions for research or internships and other things. And obviously the economy and higher education or education go together, hand in hand.
Yep.
Do you track that? Are you watching that? What impact do you think that some of these reductions on higher education may have?
We don't get, you join the Fed, you're out of the fiscal policy business. So I'm not telling you, if Congress and the president, they can pass any bills they want. And our job, I always say in the Midwest, motto is there's no bad weather, there's only bad clothing, and then that's the Fed too. You tell us what the conditions, and we'll tell you what jacket, that we're supposed to wear. Now that said, we do track this, and some of the direct ways that it affects our dual mandate and our thinking about inflation and employment are by far the best jobs program in America, really in the entire world, is raising the skill level and the education level of the workforce. It's undeniable. You look at the data, the same people, the more skills you get, the more likely you are to have a job, the more that job is likely to pay. So if we're going to slow the educational attainment, it is going to have an impact on the labor market. And number two, the scientific research is a fundamental building block of the productivity growth rate in the country. And if we slow the amount of research spending done by the government, we got to keep an eye on, is the private sector stepping in to fill that void, or is it just going to be a reduction in spending on R&D? So far, it's been an overall reduction of about 25% in R&D spending. If so, not in the immediate term, but over the medium to longer term, I would expect that to affect productivity growth in a negative way, and that will mean wages can't grow as fast as they've been growing without generating inflation.
I want to talk a little bit about supply chains, certainly critical for the manufacturing sector. We saw the fragility of global supply chains during the pandemic. Obviously, policies under the former administration, the current administration, trying to de-risk supply chains, reshore production back in the United States. But broader economic implications of the shift, is it inflationary? Could it lead to greater long-term stability and innovation? But how do you see the whole supply chain issue globally?
The guy from the Illinois Manufacturing Association asked me about the supply chain. I should just be asking you about the supply chain. Look, the damage to the supply chain, the theory went, why was the Fed, and I wasn't there, so if you have beef with the Fed at circa 2021, 2022, that's not my problem. Go take it up with someone else. But the original Fed argument, which was matched by most private forecasters too, about inflation, and why did they say that it would be transitory? It was rooted in, hey, there's a damage to the supply chain, and they'll fix it, and once they fix it, then the inflation will go away, and that should happen, this quick. And it just proved to take far longer than anybody thought it would, or than it was supposed to, than the textbook kind of assumed would happen. And my conception of it is it was this spillover bit, that it was, okay, they can't make the transistor in Malaysia, but if they can't do that, then they can't, so that the cost rise of these inputs. Well, then the people who are making whatever, the radios that go into the cars, now the price of those is going to go up. So now the people who buy the radios, the OEM car manufacturers, the price of the cars is going up. Then the people who are relying on the cars, the delivery companies, their price is going up. And that spilling through the supply chain was a huge problem. It was a huge problem everywhere. In every industry, autos is sort of the mother of all supply chains. There's 10,000 different parts in the typical car. Every single one of them's got its own supply chain. But I could go through, I could give you the whole list of toilet paper. You remember when it was like, there's no toilet paper. And people thought it was like, my stupid neighbor's buying all the toilet paper at Costco. It wasn't. It wasn't primarily that. It was that the toilet paper supply chain, there's two completely different supply chains. One goes through retail, it's like fluffy Charmin, and it comes on little rolls that you put in your house. And the other are big rolls that go through the office supply chain. And everybody stops going to work and starts going home. And as I described, there's a great depression of the bathroom in the office toilet paper business. And there's a more demand than anyone's ever seen at the grocery store. And those are different factories and they're different supply chains, and it took a while to figure. That's a very, very simple supply chain, and the whole thing broke down. My fear, if the tariffs get too big, the more we say, you know what, we're going to exempt this thing, we're going to sign a deal, and we're not going to apply the rates, we're going to extend, now we extended the pause on the Chinese tariffs. The more that happens, the more comfortable I get. Hey, it's not going to be bad. The more we're going to add 50% tariffs. The tariff rate was about 2.5% before we got into this. So that we went to 10 and then 15, we're way, way up from where we started. The bigger the tariff gets, the more I hear from the manufacturing contacts, the more it starts to feel like the supply chain disruptions of COVID. So I do think we learned that the supply chain is more important and more fragile than we ever imagined. I hope that we've made it a little more, I was going to say resilientified, is there some word? Made it more resilient. I hope that we have, but I'm not sure. How did we get to the single source supply chain that we had before? It's because they're big economies of scale and it's cheaper. So we can pivot to make it more diversified, but that probably will come at the expense of it'll be a little more costly.
Yeah. One of the other big issues that we all talk about is housing. We see it in central Illinois. We see it around the country, housing challenges. How does the Fed Reserve, what tools do you have for assessing various sectors, identifying risks like a coming housing bubble or maybe a tech over-evaluation? And how do you look at housing when you're shaping policy choices?
Housing is instrumental in shaping policy choices because it tends to be historically, one of the most cyclical sectors of the economy and most interest rate sensitive sectors of the economy. Now, the Fed, as you know, sets the Fed funds rate, which is an overnight rate. And the rate that affects mortgages are like 30-year long interest rates. And they're tied, but they're definitely not the same. The Fed doesn't set mortgage rates, the market kind of sets mortgage rates with influence of what they think the short rates are going to be. I'm hesitant to declare something a bubble. I think it's super hard to figure out what's a bubble in real time. And in the back of every economist's mind who starts thinking about that question is Milton Friedman, who, when they said, should the Fed be using interest rate to fight bubbles? And Milton Friedman said, if you're so confident that that's a bubble, why doesn't the Fed go short stock? And you'd be like, well, that's too risky. He's like, but that's the same idea. So I prefer to think of it as, let's call it risk management, or let's call it trying to think through the channels of if you had a big change in asset values in some sector, whether it's commercial real estate or residential real estate or the stock market or whatever, what are the channels that might affect the financial system and be a threat to financial stability? And the Fed thinks about that a lot, as well they should. The housing challenge, if you have like a kid in their 20s, you will know that, well, I don't know if they're getting it on TikTok or where they're getting it, but they're building up this resentment against their parents of like, you know, when you were young, you could buy a house. We can't afford anything. The price of housing is through the roof. And they're not wrong about that. If you look at the relative price of housing versus goods, okay, you're going into Walmart and just looking at how much physical goods cost compared with how much buying real estate costs. That's diverged at an extreme level in the last couple of years. But the thing that I want to emphasize is that didn't start in the last 2 years. Okay, if you look over the last 20 years, we had less than 2% inflation for most of the 2010s. But that didn't mean everything was 2%. Housing inflation was about 3.5% a year, and goods inflation was negative 0.5% per year. Okay, so we've had the relative price of housing versus goods going up 4 or 5% a year compounding for 20 years. Okay, now it doesn't take an audience as sophisticated as ours today to know that if you compound a thing 5% a year for 20 straight years, the relative price is going to look high. And that is what's happened with housing. So the 20-year-olds are not wrong. The only thing that they are wrong about is that's not a sign that their cost of living relative to their income is worse than the parents. It's like, you can buy a lot bigger, nicer TV than we ever could buy, and like your phone is a lot nicer than my phone. You know. But that said, the affordability challenge of this moment, I think a lot of it is related to this relative price of housing.
And one of the questions that came in from one of the...
comma, and the Fed can't change that. The Fed can't, we don't really have tools of how do we change the relative price of housing versus goods. Okay.
One of the questions that came in from a chamber member was on the housing.
Yeah.
How concerned are you that by lowering interest rates, housing prices will continue to move higher and make home ownership further out of reach of young folks?
Okay, that's an interesting idea. I guess I would back up to the first thing I said. If we don't set the mortgage rates, the Fed sets the short rate, okay, the mortgage rate is determined in a marketplace. And long rates, there are a lot of things that influence them. The amount of treasury issuance is going to come from the deficits. That's going to influence the long rates. And fundamental in this, and I want everybody who's kind of getting into the battles over Fed independence, I want them to all remember that one of the major determinants of what the long rates are, which directly influence markets, is what do people think the inflation rate is going to be long term. And if you're in an environment where the Fed or the central bank is not independent, long run inflation is going to be higher and mortgage rates are going to go up, not down in that environment. So we want to kind of think those through. Lower rates can drive up prices, but at the same time, lower rates reduce your monthly payments. So there is a bit of a balance there.
I want to give you a chance to showcase, and I don't think a lot of people realize all the research that the Fed does and the information that's available to the public. The Chicago Fed puts out a beige book. Talk a little bit about the beige book, the health of the economy, and just some of the resources that are available to business owners, banks, what have you.
Okay, if you, I cannot recommend enough the research at Chicago Fed. Just go bop along on the webpage. You're going to see fascinating studies. We have one of the best research departments. I say it's the best, but that pisses everyone else off. So I say we're among the greatest of the research departments of all the Feds. and they do fascinating studies. Those are kind of longer run studies where you can demographic changes, the impact on the economy, the state of the labor market, inflation, things like that. There's also a bunch of data, just pure data that you can track down and is accumulated on there. And I can't recommend that enough. Now, the Beige Book is put together, every Fed Reserve Bank will put together intelligence gathered from their contacts. And the effort of creating the Beige Book, which used to be a book that was beige, and now it's a PDF. So I don't know why they still call it a Beige Book. But those are fascinating to get a real-time read of where people's heads are. But that's very similar to if you talk to your friends in business. That's basically what the Beige Book is. Sometimes they get some attention in the Beige Book. The Philadelphia Fed had some comment about Taylor Swift came to town, and that was a big increase, in hotels and something. And then it was on the radio, and Taylor Swift is driving up the economy, so there can be some fun elements in it. But if you want real-time indicators, the Beige Book is a pretty good one.
And I know we're getting close on time. Energy is such a huge issue globally.
Yeah.
We're putting a user the size of Japan on the market the last 2 years. Yeah. It had been relatively flat. Obviously, new AI and quantum and data centers and manufacturing, energy markets obviously globally. Talk a little bit about what you see with energy and how that factors in, and how you look at energy and what you foresee coming.
I tend to view, so the Dallas Fed is what we are to autos, the Dallas Fed is to oil. So if you're thinking about that kind of energy, the Dallas Fed does great work and is worth looking at theirs. On electricity energy, it's what you described is exactly correct. Unexpected, I think a lot of it being driven by these data centers. I mean, data centers are growing leaps and bounds. The demand for energy coming from those data centers is extremely high. I tend to think of energy as the purest of the inputs, okay? Just purely an input into manufacturing, into other businesses. So if you have a big increase in demand for energy from one sector, it's gonna raise the price of that input for everybody else who needs it. And you see that. You're seeing the kind of the on-the-ground competition locally. It's also a very geographically localized kind of a market. So if we're going to go into a period in which energy prices are going to be higher, I do think we're going to have to think that through. What does it imply for manufacturing, and what is it going to imply for the cost structure? But it doesn't have to be that way. It all depends on how much supply is going to be able to come online in energy.
Yeah. And two last questions, and quick. You've talked about the golden path in the economy earlier today. What is the biggest risk that you think can derail us from the smooth transition or smooth landing?
In a way, we're on this two-lane highway where there's inflation and employment, and we could fall off either side. So one risk would be we get back into an environment where costs are rising. We've been above the 2% target for 4.5 years. Now, I was still feeling okay about that, even though we've been above for 4.5 years, because it was coming down. If we get into an environment where it's not coming down, we're above 4.5 years, and it's going the wrong way, and that's looking persistent, that would be a problem. And in my opinion, the Fed will have to act. And on the other side, if we have a more traditional slowing of the economy, and there are some warning signs in the labor market, that would no longer be the soft landing we would have had the hard landing. And so I kind of think both sides of that we got to keep an eye on.
And the most important question, over under, how many wins will the Bears have this year?
Can you get more than 17? Yes. Yes, you can.
Everyone join me in thanking Austan for a great conversation.